Hi there, hope you're doing great today. What do you do if you receive the dreaded capital call or if your investment failed? We answer this very question in today's quick video. But before we begin, just a quick reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. What do you do if you're faced with a cash call, also known as a capital call situation? First, take a deep breath, don't panic, and look to understand the situation, the facts, and what your options are, if any. So, how do you do that? First, it's important to understand if you're putting good money after bad. In other words, understand the reason for the capital call. Is it due to operator error, things that could have been prevented all along the way? What are the future plans? Will those future plans and projections for the property get the investment out of the negative situation, cash flow and liquidity that it is in? Or are these just hopes for a better future without any substantive information, data, and proof of action? So understanding what caused the capital call, what the future plans are, the viability of those estimates and projections is key. Or was the capital call caused by exogenous factors? For example, nobody could have forecasted the rapid rise in insurance rates or how fast and how high rates would rise in the past year or so. With that said, certain operators may have mitigated that interest rate risk exposure by hedging the interest rate, but as a lot of these short tenor loans, bridge loans, are coming due, in order to extend or renew, lenders are now requiring that operators mitigate that exposure again, and that they have enough reserves to purchase a new interest rate cap, for example, and or enough reserves to meet the current loan to value requirements of the current market environment. So it's important to understand if, for example, that additional capital contribution perhaps would transition the investment from variable, short-term, fixed, short-term rate debt to more permanent financing with fixed rate debt, enough of a timeline to finish execution on the business plan, stabilize the investment, and hopefully exit at a profit. So there may be good factors, there may be bad factors. You ultimately want to make sure that the drivers for the call are really problems that can be solved and that you're not just throwing good money after bad. Definitely, if you don't feel well equipped to review or re-review rather the operating agreement, it will be good time to consult with a seasoned attorney who can help you read through that and understand what your options are, if any. For example, is the cash call mandatory? Is it punitive? The most typical penalty for not participating in a cash call is effectively the risk of diluting your investment should other investors step in and contribute that amount instead. But there are some cases where there are certain penalties assessed for non-participation. So you'd like to understand that and ultimately determine, is this something that you are comfortable with? And last but not least is take a step back and reassess what are the lessons learned. It's certainly painful, not pleasant to go through an experience like that. But at the end of the day, we're all learning. We're constantly learning and growing. We typically learn from our mistakes, and not that this was your mistake to begin with, but really assess what would you do differently next time you invest. Would you vet the syndicator differently? Would you vet the underwriting differently? And so forth. And last but not least, one thing I forgot to mention, that call shouldn't really come as a surprise to you. More likely than not, the syndicator would be communicating to you ahead of time and keeping you appraised of perhaps some of the challenges that are transpiring. If they have not been doing that, that's obviously a problem, but if they have been and perhaps you have not paid attention to the monthly or quarterly updates, that would be another lesson learned and something to apply for future syndications and future investments. Namely, monitor closely your investment, and if things are going well and everything is going perfect, then that's a quick read of the monthly or quarterly reports. But if things are not going great, then at least you'll stay abreast of such changes and updates. So we hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.